Hello, everyone. Welcome to episode 14 of the Brandon Adams podcast. I have with me a longtime friend, Aaron Brown. He's the author of Poker Face of Wall Street and Red-Blooded Risk. He's also an adjunct professor at NYU. Aaron, it looks like a very nice spot you have there for quarantine. I'm jealous. It looks really peaceful.
It is really nice. You know, there's some research that says humans are most comfortable when they can see some sparse trees so you can spot predators, but you have some protection and water. And that, you know, for millions of years, that's what's put us to sleep, made us happy, made us feel safe. So that's why I picked this spot.
And this is like your reading room / office, I'm envisioning?
Actually, I'm doing taking the opportunity to do a lot of house cleaning that's maybe 5-6 years overdue. So I moved all this stuff into the bedroom so I can clear out the other rooms and start, you know, doing some refinishing and cleaning and so on. So this is a view from the bedroom.
Yeah, I think everyone's trying to do some of that at this time. Some organization. I remember reading
to when I was in college. You know, you had a paper due, you cleaned your dorm room. You know, that was just.
I remember reading Getting Things Done, and he said that most people, their to-do list would take a year if they stopped their life. If they wanted to get through their to-do list, it would take a year. And that sounds about right. And I've always wondered if it's advisable to try to get through your to-do list, because one very successful guy that I knew, he had a piece of advice that I think was really good advice. I don't tend to follow it, but the advice was the top 5 things on my to-do list every day are the things that make me successful, that make a lot of money. So I just focus on those top 5 things and ignore the other things. And I think it's somewhat good advice, because I always find myself focusing on the tertiary activities that maybe one, I'm not very good at, and 2, are not so important.
The trouble with that, I mean, that sounds good, and it may well be right, and the guy was successful, but I find that I accumulate lots of things that I probably don't really care very much about, that just loom very large. They just kind of drag me down. And when I actually get around and I start doing number, 6 to 20, I find out 10 of them no longer matter. You know, either I let them go too long or they went away by themselves, whatever. 3 or 4 of them are so easy. I'm just annoyed. Why didn't I do this, a month ago, when it took 2 seconds to actually do it? And, 2 or 3 are really hard and I can't do them, so I just toss them off the list. And there's a great feeling to having no to-do list.
Absolutely. It's hard to get there.
All of it. Then you can sit back and have a drink and not worry about what you're going to do. And you can pick what you want to do. That's my personal happiness. I'm doing the thing I pick because I feel like doing it right now. I'm happy. When I'm doing stuff because, okay, I gotta do the lecture notes for the class, and then I gotta pay the bills, and then I gotta do the taxes.
Well, I think we have the same construction. Thinking back to when we first met, which came first, me reading your book or you reading my book, Broke? I believe what happened was I read the review of your book in the New York Times book review. I read your book, found your email, and emailed you, and then around the same time, I had come up with Broke, a poker novel, and you read that, and then we got together sometime that year. Is that right?
Your memory is at least equal and probably better than mine. My recollection is I ran across you when I was researching Poker Face of Wall Street as a poker player who also had some educational credentials. And I was interested in talking to people like that for the book. I thought I contacted you, didn't hear from you, and then heard from you later. But again, I sent out maybe 200 emails when I was researching the book, and I got maybe 20 responses, and some of them were really good. By the way, one of the great joys of writing a book is meeting all these people who you
If so, I would have responded. I believe that you probably had the wrong email address back in the day, but
Okay.
but that is how I remember it. That New York Times book review. I read the book review. I said, "All right, I have to read that book." Read the book, then contacted you, and then you read Broke, and you liked
Great
it.
novel, by the way. Really great novel.
Thanks. Yeah, I'll have to reread it sometime and see see if any of it holds. And then I came to your office a couple different times, and I was coming to your office around the time of the financial crisis. I remember once, well, in the midst of the financial crisis, and then we had a long meeting at AQR after the financial crisis, and I was hoping, because a lot of the viewers of this podcast, they are poker players or sports analytics people that have recently become very interested in markets and economics because of turmoil in the markets and life. And I also think, strangely enough, that some poker players and daily fantasy people, they want to try their analytical chops on markets now that that's the only game in town. So I was hoping that you could take us back to the financial crisis. I feel like possibly your understanding would be unequaled. So I don't know where you want to start that story, but take us back to those years.
Well, I would say so. Things started in, let's take January 2007 for a convenient starting point. This is something actually. This is almost 10 years ago now. I remember I was cleaning up my office or something, and I came across a newsletter, a financial mortgage newsletter from January 2007. And on the front page, they had every major thing about the financial crisis. They had mortgage delinquencies were going up to unprecedented levels. People weren't making the first payments on their mortgage. Huge amounts of fraud were being found. Subprime was particularly hard hit, and financial institutions were over leveraged and undercapitalized. But the headline was how there was a bidding war on Wall Street because there was only one major subprime mortgage originator who wasn't owned by or affiliated with a major financial institution. So as late as January 2007, all the problems were pretty well known. Yet people were still, as Chuck Prince said at the time, they were going to keep dancing until the music stopped. Despite knowing full well all of the things that were going to go into this problem, there was a bidding war for mortgage originators who, 6 months later would be going bankrupt. So you go into the summer of 2007, and you've got the quant equity crisis. Very dramatic for quants, but really nobody outside of the quant world noticed. A guy named Scott Patterson wrote a book about it, and it was actually a pretty good book, but he has a real unfortunate thing that by the time the book came published, nobody cared about it anymore because there was this much bigger crisis. Fall of 2007 is when we really saw the major market dislocations. It wasn't tremendously bad for markets. Stock markets hit a high in October 2007, but the money markets had frozen up, the repo markets had frozen up, interest rates had interest rate patterns could be arbitraged. There were inconsistencies in interest rates. So you continue on. Bear Stearns goes in February 2008. And everyone's saying, okay, the Fed is going to rescue, the government's going to rescue anybody. And I'm saying, no, that's exactly the wrong message, because they got so much negative pushback from the rescue of Bear Stearns that they're going to let the next one go. And of course, that happens in September with Lehman. Also, AIG, Merrill, all of those go. And sort of everything hits bottom around December of 2008. But then things get better very rapidly. we were running formal drawdown control at AQR. And so we were cutting positions. We cut positions by about a third going into summer or coming out of the summer of 2008. And that doesn't sound like a lot, but cutting your losses by a third can be the difference between surviving and not surviving. You cut more through the fall, but then we were putting positions back on in December. The bottom is somewhere between December and April of 2009, and then things go on to have the longest bull market run in history, which only ended quite recently. So that was our crisis. I think people are hoping for something kind of similar this time, a sharp correction, bottoms out in a month or two, possibly around the time the virus infections and deaths peak in the United States. And then we rapidly go on to another 12 years or so of spectacular bull market run.
Well, we'll come back to that, and you suggest your viewpoint there, but we're going to come back and revisit that. Stepping back into the crisis time, in the summer of 2007, you had that ugly first couple weeks of August.
Ugly for quants, but not a big decline in the market.
But that was the time that
in October.
It probably would have been a bigger decline had Countrywide actually gone under, because you had Countrywide start to tank in the first couple weeks of August 2007, but then that was sort of erased by Bank of America stepping in. But you had an ugly week, and my recollection was Countrywide was basically halving over the course of 1 week, and you had two things come in to change that. That Friday, the Fed did an emergency 50 basis point cut, and it was somewhat effective in alleviating pressures. And then that weekend, Bank of America announced a bid for Countrywide, and then kind of things stabilized for August.
Yeah, that's correct. And in fact, for financial firms, the peak was in May. So financial firms are already declining at this point, not dramatically so. Countrywide, back in May, it had to turn over its balance sheet every 36 hours. So you got to think about that. You're a CFO of Countrywide, and you're writing mortgages, billions of dollars of mortgages, and you're securitizing them. You're putting them in warehouse lines and then securitizing them. And if anything interrupts your business for 36 hours, you're insolvent. You're gone. You have to turn over this stuff constantly. So that was always kind of a fragile situation. Any kind of hiccup in the repo markets and the warehouse financing, in the securitization pipeline is going to cause problems. What books would call a tightly coupled system. So in August, my recollection is people were thinking of Countrywide as having had a fragile business model, but it wasn't a question of the fundamental value of their mortgages. It was a question of getting a more secure and stable financing arrangement so that they could, survive a 1 or 2 day hiccup in the money markets.
Now, you note that in late 2007, markets hit records. You basically had a strong fall of 2007. It's interesting to note that fall of 1999, fall of 2007, and then this past fall before the blow up of the past couple months, they were these extreme tops. Did you note any similarities, or do you have any guesses as to why markets in those three instances sort of put all worries aside and went straight up?
Whenever people have sort of timing theories, I remember, I don't remember if it was Mark Twain or Will Rogers or somebody else said, October is a particularly dangerous month to invest in the stock market, and the other 11 months are January. Yeah, it does seem like, we get peaks in the fall, late fall, October or so is is a big month. And maybe that traces back to the agricultural cycle, from a couple centuries ago. I don't know. But yeah, I would say I was hearing a lot of the stuff in fall of 2019 as I heard in fall of 2007, which is that markets are at an all-time high. They've been going up for too long. Credit spreads are ridiculous. That terrible credits. Countries that have defaulted every 20 years for the last 2 centuries, or leveraged loans where there's virtually no equity, and these things are trading at crazy credit spreads, single-digit credit spreads. But the difference is, in 2007, people hadn't been saying that for very long. In 2007, people were just starting to say it. 2007, the major recollection of everybody is the NASDAQ crash of 2000 and a couple of years after that. So it's only recently that people are starting to say things have been too good for too long. In 2019, people have been saying that since 2012. And I don't think there was particularly more, those were louder voices in 2019 than they have been for the last 7 years. Yeah, all that stuff is true. It was very hard to justify price earnings ratios, credit spreads. It was unbelievable that we could have a bull market that went on for 12 years. But, it was unbelievable that it went on for 11 years and 10 years, And so I don't think there is any particular presentment of this. On the other hand, I do believe that much of what we're seeing wouldn't happen without the virus. I think the virus triggered things. It increased the panic. It means the stock market crashed more sooner than it would have. But a lot of the problems were, the credit problems. The credit problems are not from the economic shutdown, slowdown, whatever, caused by the virus. The credit problems are that, more money was lent than was ever going to be repaid. Stocks, the stocks are still in very high price earnings ratio territory, even with all the lines we've seen. So I don't think that we can really blame the virus for everything. It's always convenient, to blame the virus. In fact, people were blaming the virus for fourth quarter 2019 earnings being low. It's always convenient to blame something far away beyond your control for things that happen. I would say, I'm going to go out on a limb here. I'm not sure that 2020 financial market returns for the full year are going to be significantly different than what they were without the virus.
Well, that's an interesting take for sure. And I imagine that relies on the extreme fiscal and monetary stimulus that's going into markets, or does that have nothing to do with it?
Well, that's part of it, right? So you've got sort of two technical things going on that aren't really fundamental to the economy. You've got the slowdown because people aren't going into work. And you've got the stimulus from people having lots of money. And I'm sort of betting those two things largely offset. The total amount of toilet paper people are going to buy over the next 10 years has not materially changed. Yet the pattern of when they buy it has changed dramatically. New cars, nobody's buying a new car today, but I don't think the total number of new cars sold over the next 10 years has changed. So the fundamental economy is what it is. It's sort of temporarily postponed some things, and other things are accelerated. But I don't see any huge net effect from that. Again,
you might get unfortunate distributional effects if that turned out to be true.
Distributional, you mean that there are unemployed people today and there will be labor shortages next year?
More the fact that the monetary stimulus, if it does mean that the end of year stock values and bond values are what they otherwise would have been, the wealthy would be better off as compared to the less wealthy. The crisis, the virus would have hit unequally.
Well, it's certainly going to be unequal, right? Some people would be dead. Other people will have, not been infected, will have not lost any income, and will have received, benefits. from stimulus. I don't think it's a lot of rich. Well, okay, and here's something else. If you're talking about distribution with countries, that's absolutely true. People in rich countries will be much better off than people in poor countries. I don't know that it's particularly true that in the United States we'll have more wealth inequality at the end of the year than we would have expected anyway. I suppose it's possible, but I think the main effect will be small of the virus itself. Again, I don't know this, and we'll never know, because we'll never be able to run it again under the other circumstances. But when I'm looking at the price changes we're seeing, they're very rational changes. In the 2008 financial crisis, we had lots of inexplicable things happening. 1987 crash, we saw a total restructuring of relationships of financial prices. Now we're basically seeing the kind of things that a value investor would have predicted. Anyway, credit spreads go out, price earnings ratios come in. This probably was baked in before the virus.
Yeah, that makes sense. And with regard to the virus, before we started, you gave a contrary opinion that New York City will likely not be operational or not be close to the same in the fall, which most people, I would say consensus take is that the fall is probably back to normal.
Well, here's the problem for New York. Okay, so they've got these, massive infection numbers, and they're going to peak and they're going to go down. But it's well, if they open it up to international travel, to people coming from all over the country, the virus is not going to be gone at that point. It's not going to be contained throughout the world. If New York City maintains the kind of restrictions that could restrain the spread, it's going to lose its value. I mean, you look today. Today, the subways in New York are packed. Everybody riding on those subways has made the decision that they're probably going to get the virus, and it's worth it to them to get wherever they have to go. In that kind of environment, it's very difficult for me to see that you've eradicated it. Now, you may get it down to a reasonable level. The big promise of the 15-minute test. If there's a 15-minute test, then yes, people should be able to take the test, isolate if they have the virus. I don't think people in New York will. I think if you're on a subway car packed with 200 other people, it's not unreasonable to guess that one of those people either hasn't taken the test or has taken the test but still feels that it's more important to travel. If New York shuts down the subways and shuts down the airports and, checks people for fever at the George Washington Bridge and so on, it's not really New York anymore.
So you think that in the fall, they're going to basically run the city as they are now, and people are just going to stay away because the probability of infection is high, or you think they'll take measures that are more strict?
I don't think they will take measures that are more strict. Now, there's two things when we're talking about the fall. First of all, there's a possibility of a resurgence, like influenza. Maybe things will die down in the summer and come back in the fall. I'm not really talking about that. I'm just saying that there is going to be residual infection levels in most big international cities. Just be impossible to get rid of it. The people who are there are going to be the young people there'll be people who have already had it and think they're immune. And there'll be people who are young who figure that, well, if I get it, it'll just be like flu and I can handle that risk, given all the opportunity of being in a city. The value of being in New York, if you're in certain, young, ambitious person is tremendous. Plus, many of the people in New York don't really have other places to go. Pretty much everybody I know from New York is now, and about 2 weeks ago or more. But I also do know that there are lots of people still there, trading financial markets, running the businesses and so forth.
So on a slightly different subject, the NFL, I've been posing the question to friends of mine who don't mind venturing predictions. What do you think the probability is that the NFL plays a game with fans in the fall? With a full on NFL game.
Yeah, yeah. I mean, I think the most likely scenario is the NFL holds a season without fans, purely for television. I don't think that would be a dramatic, loss to the revenue. Yes, they lose, all the money from people actually coming to stadiums and so on, but a lot of, and there'll be increased viewership because people have fewer other things to do. Although I don't know who's going to be advertising on it, but yes, somebody will be around to advertise. So that would be my number one prediction that league does. If they're going to open with fans, it's almost got to be, to me, either that the virus has been completely contained, which could happen. I mean, SARS and MERS both pretty much went away on their own. And this virus is very similar to the SARS-1 virus. Or there is a testing and isolation regime, the 15-minute test, get people at the stadium with those infrared. I don't know if you have those in Florida, but out here in the Pike County, you want to go to the supermarket, they give you an infrared thermometer, temperature reading for the electrician. They don't show it to you. And my thought is that, if you're at New York plates on your car, or you're driving a BMW, they're going to decide that your temperature is too high. I just can't see without those kinds of advances, which we don't know yet, or even better, a vaccine, that they would open up to fans. Other sports are more difficult. Baseball, for example, would be a much bigger loss for baseball to give up the fans. But I think the main reason the NFL has fans in the stadium is to make it part of the show. That they would be, if you could run the league on pure economics, you'd just do an all TV league, and the fans are just part of it, like cheerleaders, they're like, halftime shows. They're just sort of part of the thing, make it seem more like a sport and less like entertainment.
Yeah. So it sounds like your view is maybe 10-15% that they have a game with fans.
Call it 50% games without fan, 10 or 15 with fans, and whatever 30% or so that they cancel the season.
It sounds like you have that view about the virus, but markets, you say they will finish the year the same whether we had the virus or not. Now, does that mean that you were relatively pessimistic about markets before the virus because of valuation concerns, and you think they were going to just find their level anyway? Or do you think the level is the same because the monetary stimulus is so aggressive?
I've felt for a few years now that markets were overvalued to the point where expected returns over the next 5 and 10 years were much lower than historical averages. So one way you could work out of that is you could just have, 5 or 10 years of mediocre returns, stock market returns 2% above inflation, market, returns basically matching inflation, and something along those lines. Or you could have a crash, and then you could have a crash, and then after the crash, you would have a normal expected returns going forward. I am no good at predicting whether you get the extended period of below average returns or the crash followed by average returns. And I have no ability to predict the timing of any of that. But I am modestly confident I don't want to say confident's the wrong word. I think the odds are on your favor if you kind of go with valuation ratios over long periods of time. And the valuation ratios we're seeing now are reasonable valuation ratios. In fact, they're still somewhat high. So even at the market today, I don't think I would bet on below average returns over the next 5 or 10 years compared to history, but not as much below average as I would have bet before this crash.
And on the subject of monetary interventions and monetary stimulus, you have over the years had a lot of interest in monetary economics, and Uh, I don't know if you still are a Bloomberg columnist, but you were for a long time. And I noticed that a lot of the columns were about Bitcoin and alternative coins. So I'm wondering if you could go into how your interest in Bitcoins originally developed and where it might be now.
Well, first of all, I am still a Bloomberg columnist, and it's easy to find me. Um, I've actually been interested in alternative currencies since the late '80s or so, possibly even earlier. And what you may know about that period is the people who were working on this stuff at the time, the cypherpunks and others, they had a much broader agenda than, using Bitcoin to do transactions. And a lot of fascinating both philosophical and mathematical work. So I always kind of followed that. I didn't really pay much attention when Bitcoin came out in 2008. It didn't seem, all that much more. There had been previous innovations like DigiCash, for example, much earlier, that seemed much more promising. It seemed like they would really take over. Bitcoin seemed like a pure hobbyist fantasy. And then it was in 2011, I hired a web designer from Bulgaria, and I wanted to pay her $1,000. Sorry, £1,000, 1,000 English pounds. She needed pounds because she wanted to buy computer equipment in England. And we figured out that for me to if I put out the value of £1,000, she would end up with less than 200 pounds between, transfer fees, exchange fees, Bulgarian regulations, and so on. But then she said to me, look, just buy some Bitcoin, send me the Bitcoin. I can use the Bitcoin in London to buy the computer equipment, and I can have a friend bring it back to me and just take it through customs. And I can get the full value of £1,000. And, that hit me. Wow, that's really, that's incredible value. People are really going to want that. So I went out and I started buying Bitcoin. I did a calculation. I said that I think crypto will be 2% of the world economy. In comparison, the internet is about 7%. So 2% for crypto seemed reasonable. So I said, I should have 2% of my portfolio in crypto. And I've maintained that ever since. I haven't changed my 2%, even though, there's so much uncertainty about things like this that there's really no point in micromanaging it. And that's been very, very good for me because I sell when it goes up and I buy when it goes down. So even if it goes to zero tomorrow, I'm well ahead of the game. I continue to be interested in some of the ideas, although I admit, they are gaining traction and taking off a lot slower than I would have predicted. I mean, there's some really great crypto ideas out there that on paper work great, and yet just don't seem to generate any enthusiasm. But once one catches on, perhaps it'll catch fire. And by the way, when I say all of them, I'm really talking about a couple of dozen really good ideas out there, and then maybe 100 or so sincere but kind of optimistic or sketchy ideas, and hundreds and hundreds of frauds and delusional stuff.
Can you tease some of the ones that you think are especially good ideas?
I haven't been following it lately, and been focusing more on other things. But basically, there's two bits of value that real fundamental value. One is the network that the currency sets up. And if you wanted to say, like Telegram, for example, has a very valuable network. It's never managed to really monetize it, but it's out there. And the other is the technology. Some of these things have really good technology behind them. I'm thinking that, if I were to start, taking a hard look at my crypto portfolio and just rebalance, I think, the virus should be a great thing for crypto, right? The stimulus runs a risk of massive inflation, massive tax increases, perhaps, getting your wealth not dependent on what how much the U.S. dollar, how many U.S. dollars, government spends, not having it depend on possibility of wealth taxes and things like that, should be enormously appealing today, much more appealing than it was a few months ago. But when you invest in crypto, you're really investing in two things. You're investing in high-tech technology companies, really speculative ones, and you're also investing in some sort of currency, something of some exchange value. And crypto has been moving up and down like NASDAQ, like small cap NASDAQ stocks, like venture capital stocks. It's been getting hit very hard because in a financial crisis with cost of capital going up, people aren't that interested in funding really high risk speculative ventures. And that makes sense because that is part of the appeal of crypto. But I think that as the dust settles, people are going to get back and start looking at some of the exchange value for this. If borders close, if there's more financial repression, if there's more inflation, crypto should have a lot of value. So I think, it would be, if you're interested in this stuff, I'm not giving specific advice, but I would say, take a good hard look at which currencies are going to be useful in a post-virus world. And if you can't make up your mind, Bitcoin has really proven to be a pretty good index for the sector. And my feeling is, however it shakes out, whichever currencies succeed, whichever ideas and companies succeed, I'm talking about the, distributed autonomous organizations, not just the currencies and the coins. I think Bitcoin will be the funding currency for those. So therefore, I think that, its value will go up and down as those other crypto ideas succeed. Plus, it does have some value as an exchange currency, although, it's kind of disappointing if you're a Bitcoin fan that it has failed to demonstrate that during the crisis to date.
The upcoming halving, is that well anticipated by Bitcoin pricing historically? What is the...
It was going to be a big event. Okay, so 12 months ago, we thought it was going to be a big event. But mining profits have dropped so much that I don't think it's a constraint anymore. So I don't think it matters. 18 months ago, the constraint on mining profit was, getting enough new machines, getting enough new electricity, and so on. Now we have surplus, and so it's going to be pushing on the string.
You mentioned the idea of 2% of your portfolio in Bitcoin. I've recommended your book Red-Blooded Risk to poker players that have a new interest in financial markets. When I'm first explaining it, I say, well, you're used to thinking about things in expected value terms, and that's a fine way to think about things at the poker table or when evaluating like a one-off proposition. But over the long term, it will suit you better to think about things in terms of geometric returns. And I think Aaron's book would be a good place for learning to think in terms of geometric returns, and B, learning to spot where exponentials are in play, and you can use it to your benefit. Am I giving a justice with this brief description to Red-Blooded Risk? I think it's a very good transition for someone who is thinking about things in gambling terms to one that needs to think in more sophisticated risk management terms.
Yeah, that's what I try to do, and that kind of mirrors my own evolution. So, back in the 70s, early 70s, I'm studying quantitative methods, and I'm coming to the conclusion, hey, the stuff they're teaching, nobody would bet a nickel of their own money on it, right? All these quantitative methods for statistical prediction or policy. And so I said, I want to really find out what works. And the way you find out what works is you go to Las Vegas. If you win money in Las Vegas, it's not because you played the office politics right or academic politics. It's not because you had some clever math. It's because it really works, and people are trying very hard not to give you money. Expected value is very valuable for learning because, the gambling table, the poker table, the blackjack table, sports betting, you get thousands of repetitions that are really relatively independent, every day if you want to. You can very quickly learn what works and what doesn't with fairly high confidence. But then you hit the limit. The hard part about making money in any kind of gambling pursuit is getting paid. If you're a successful sports bettor, it's hard to get people to take your bet. It's not impossible. There are ways to do it, but you spend more effort getting people to take your bets and pay off on them. As a poker player, and this is especially true back in the 70s, when casino poker is not, you can't make a lot of money at casino poker. You have to get invited to games, and you have to have losers pay you. Blackjack, you start winning too much blackjack, they escort you out of the casino. So, you want to take these ideas to a place where you can, increase your stake level with your wins. So, in poker, you can do that for a while, right? You start as a 1-2 player, as you get good, build up your bankroll, you move to 2-5, you can move up and up and up. But, once you hit 100, 200, or 200, 400 or something like that, it gets pretty hard to find games. And the competition gets awfully good as well. So, you want to make $1 million a year actually playing poker. I'm not talking about being a celebrity of endorsements, owning a poker company or something like that. It's just, the hard part, one hard part is you have to be a very, very good player. But even if you're a really great player, it's just hard to find enough games for that kind of income. Whereas financial markets, you get up to $1 million a year, you get up to 10 million, 100 million. There's really no limit. And then expected value is no longer that important. Expected value matters less than the exponential growth rate you can engender. In the long run, exponential growth trumps any kind of polynomial growth. Expected value is kind of a linear growth idea. Even if you get squared growth or cubed growth or quadratic growth, exponential growth will eventually overtake it.
Now, on the idea of the 2% of the portfolio in crypto, that suggests that, like, you might be an anti-indexing guy, for instance, because you.
Yeah, well, here's the thing. People think that if something is very hard to value, there's no point in valuing it. They want to value the stuff that's easy to value, like an investment-grade bond with predictable cash flows. They don't want to, value like a stock with kind of unpredictable cash flows, and they certainly don't want to value crypto. Back in 1995, I did the same thing with the internet. And my guess in 1995 was the internet would be 5% of the economy. So I put 5% of my portfolio in the internet. It actually came out pretty close. 7% is pretty close. But it doesn't matter. Let's say you're wrong on the valuation. It doesn't matter, because if you have a value in mind, you're always buying low and selling high. If you buy low and sell high, you make money, even if your valuation turns out to be very wrong in the end. So the less you know about value, the more important it is to pick a value and to invest given that value. And if you guess the valuation right, of course, you're even better off. So I'm basically deep down kind of an efficient markets, capital asset pricing model guy. And I think that, okay, I want to have in my portfolio the value, I want to have the assets in proportion to the value of the world. So if crypto is 2% of the economy, I want 2% of my portfolio in crypto. If real estate is 15%, I want 15% in real estate. It's hard to actually do that because you don't really know what the values are, and some things are harder to buy than others. But keep that in the back of my mind as a mental model. So it's in theory, in the capital asset pricing model theory, the assumption is if you buy the market capitalization weighted index, you never have to rebalance, because as prices go up and down, you're automatically rebalanced. In the real world, that's very far from true. In the real world, as values go up and down, how that's reflected in actual security prices is complicated, and your portfolio will be completely out of balance. If you just go out and buy, the S&P 500 stock and some REITs and some, bond funds and so on in rough proportion to the value, a year later, your portfolio will be severely out of balance.
And you think there's value in doing the rebalance because you're tending to, as you say, sell high and buy low and capture, I guess, some reversion that happens.
Yeah, it's the old value investing. Mr. Market. Mr. Market is this excitable guy who one day wants to buy everything from you at 50% more than it's worth, and the next day wants to sell it back to you at half what it's worth, and you're crazy not to take him up on it.
I don't know if I know anyone else who invests in that concept of the world portfolio, the world market portfolio, having the investable assets spread that wide.
I should say it's really more of a thought process because you never really know the numbers. So you're guessing about all this stuff. It is a way of focusing your mind on the important things. If you want to decide how much to invest in crypto, don't look at the past action for the last month. Don't look at some future proposed, claim that it's going to be, dollar will become worthless or something like that. Just think about, can you imagine a world in which, the value of all crypto is 2% of the world economy? I think that's pretty plausible. 10%, probably not. 0.5%, 0.1%, not very likely. Now, what that doesn't mean, I want to be very careful here, is I could be exactly right. Crypto could be 2% of the world economy in 20 years, but every single crypto investment today could be worthless. So that's why you have to keep rebalancing. That's why you have to keep buying the new ideas as they come up in order to take advantage of this. When I came up with my 5% for the internet, there was really only one publicly available exposure to the internet you could get, and that was Netscape. Well, if you put 5% of your portfolio in Netscape and not done anything, you would have missed out on, Amazon, Facebook, Google, all those. So you had to keep, rebalancing constantly to make sure you were getting new ideas. And you would have been in pets.com and you would have been in, all the internet failures as well, but you still would have done pretty well.
I want to quiz you about monetary economics a little bit. We didn't go into AQR. Your title there was head risk manager, right?
Well, when I was hired, we actually didn't use chief titles.
Okay.
I was a risk manager and I was head of financial markets research. Later on, we started getting titles, and so my title kind of jumped around a little bit. I was chief risk officer for a while and so on. But I never really thought of myself that way. I thought of myself as I'm market research and risk. Those were my areas.
Market research and risk. And market research, basically, you're supervising PhDs or other highly educated individuals, and they're trying to come up with strategies that can be thoroughly back tested. And if they work, maybe they become part of the AQR strategy. Is that about right?
Well, that would have been research. And there were people who research. I wasn't involved in that side of research directly, although I did sit on, the new strategy approvals and so forth. No, financial markets research was on things like artificial intelligence, high frequency trading, trading operation. How can we work effectively within the markets? So it wasn't about making winning trades. It was about executing the trades efficiently.
In your job as risk manager, at a time like this, would you spend more time looking at credit markets or equity markets, or would it be about equal?
Well, you have people who are doing that, right? There's kind of an idea that the risk manager is looking over everyone's shoulder. If you don't trust aligned risk takers to make the right decisions, you don't hire somebody to look over their shoulder. You fire them and hire somebody you do trust. So as a risk manager, what I'm trying to do is figure out the scenarios that might be scenarios we should plan for. And these are mostly risks that arise beyond the strategy level. So I'm not thinking about, will the credit fund lose a lot of money tomorrow. I'm thinking about, is there an event in the market that will cause our funds to have, unsurmountable problems, margin calls they can't meet, loss is sufficiently great that our ISDAs get terminated, that sort of thing. So I'm looking at the plausible extreme scenarios that we can do. I'm trying to get everybody in the firm together to agree on what we're going to do. So, for example, there could be a major credit meltdown. So far we've seen credit spread blow. We have not seen a huge wave of default. We have seen some defaults in fair sales. Let's say, okay, that's what's going to happen. Let's say, all the all the non-investment grade credit are going to default, and the state and local governments, we're going to see some real risk of default. Muni bonds are a real issue. Maybe the treasury auction fails. Maybe $2.2 trillion stimulus is just more than people want to voluntarily lend to the U.S. government. At least once the initial crisis is passed, and flight quality has receded. So that's a scenario. So you kind of figure out, okay, let's I don't want to assume the worst possible case, right? The worst possible case we're all bad, as Keynes might have said if he had thought about it. An asteroid destroys all life on Earth. I want to figure out something enough beyond where our managers are thinking that it highlights factors that are going to come into play in the environment that aren't necessarily in the models and that's the in people's minds. Then we get everybody together and say, okay, what are we going to do? At what point will we cut positions? At what point will we shut down a fund? At what point will we reduce leverage? And you make that decision, and you make it when you're calm and when things haven't happened yet. And then when things happen, you say, okay, you call a meeting, you say, okay, this happened. We decided a month ago when we were all calm that when this happened, we were going to cut positions in half. Does anybody see any reason to deviate from that? And that's a productive meeting. The alternative, if you don't do that, the worst meetings of my career are things where you get everybody in a room. Okay, this really bad thing happened. What should we do? And nobody wants to say anything. Nobody wants to be the person who says, hey, we're going to, keep positions on and it's going to blow over. Nobody wants to be the first person to say, well, let's cut positions. Everybody kind of hanging on. Nobody really, you're not using the useful information. These people have tremendously valuable information that they should be sharing with consensus, but it's not coming out. If you start instead saying, okay, here was our decision a month ago, and anybody have any reasons to override it, you actually get very productive discussions. And you're not necessarily come up with a better decision, but at least whatever happens was a considered risk you took. You had the right people in the room, they had the facts, they used their best judgment, and honestly, that's all this manager could do. You can't, predict or prevent disaster. You can just hope that you get the right people with the right information to make the decision, right or wrong.
And so, what were your years in that, including the non-titled years? How many years were you at AQR, and what were the years exactly?
10 years.
10 years.
I joined in 2007, and I retired in 2017.
If you were there this year, and I don't know if this would be like a fun year to have that job or not a fun year to have that job, what do you think would be occupying your mental landscape? Would you be focused on government policy most of all, focused on credit markets, focused on day-to-day movements within the equity markets? What do you think would be occupying your mind?
Well, I have to start by confessing a guilty secret. The most fun I had in my job was always in disasters. Some of my fondest memories, and I apologize for this, and then everybody's going to hate me, were the days after 9/11. That you got this huge world-shaking crisis, right? Everybody's like today, everybody's staying home, not at least in New York, everybody was staying home, not for fear of infection, but for fear of terrorism because everything was shut down because the air was polluted. And what do you get to do? You get to make important decisions. You get to, camp out in offices. Our offices were taken over by the emergency people that were in World Trade. And And so I'm camping out in the corporate offices where I would normally never be allowed to, you don't let peons like me hang out in these corporate suite where the CEO and the CFO are. I get to camp out in the office. I get to, pull things together. I actually spent a lot of the days after 9/11 teaching senior executives how to use email and their computers. Remember, this is back in 2001, so people aren't quite so computer savvy. But, I was doing whatever it took. You just pitch in and do it. And everybody around you is doing the same thing. I happened to be camping out in the office of the person who was the very senior head of corporate travel. This person is not a traveling, a very senior bank executive who sort of handles policy and pricing and so on. I'm getting calls from people, and they're saying, I'm stranded in the airport in, Zurich and have no money, and it's just fun to, handle things like that compared to your normal day-to-day of looking at numbers and going to meetings and this and that. I had a lot of fun in 2007. I had a lot of fun in 2008. I had a lot of fun, back in, we had a series of New Year's in the late 90s. The euro conversion, the Y2K problem, where I spent New Year's Eve, at midnight in the bank, hoping that not everything would break at midnight. And actually, those memories are much stronger than my normal day-to-day stuff during markets. So I think I would be enjoying myself. It's always fun to have something to do in a crisis. I think it's a little demoralizing to just sit at home and wait for things to happen. I kind of get some, satisfaction from writing columns and talking to people, teaching my classes, because at least it feels like you're doing something. I would rather be in the markets swinging away. I would be mostly looking at what happens beyond this. I would say that I don't think there's a lot of risk management I can do that's going to make a difference over the next couple of months. The government is so unpredictable. The market is so unpredictable. You just got to hunker down, trust your models, keep leverage at levels where you can afford big changes. But I don't think people are giving enough what the world is going to look like in December. I just wrote a for Bloomberg on, lower state and local pensions going to look like in December, and it's not pretty. We can predict there will be a massive crisis because pension funds have lost about $1 trillion in assets, and state and local governments will have, be totally strapped, will not be able to make their promised contributions, and I think it could easily be the trigger. Now, granted, this has been coming on for some time. The trigger. There are a lot of other things that if you think about, okay, let's say this virus plays out more or less as expected. What is the world going to look like in December? And you want to be not just prepared to survive it. You want to be positioning yourself so you profit from it.
So the pension, you're referring to state and local government pensions, the 9
Yes.
pensions that you mentioned that are in trouble. Okay. And as you say, these are problems that Meredith Whitney wrote a book about state and local governments, and especially the pension issue in 2010 or 2011. This has been on everyone's radar for a long time, but I think partially because of the leverage in the tax base, especially in important states like California, they do very well at a boom time, and they do especially poorly in a year like this. So I think we'll start to have possibly some issues appear out of nowhere.
Yeah, well, California lives on capital gains.
Sure.
It may be a couple of years before they see any of those again. So that could be a huge problem. Illinois is actually, New Jersey, for a long time, it's been New Jersey and Kentucky have been in the worst shape, but I think Illinois is in the worst shape in December. Just because of the way they set things up. And while it's true, this has been looming not just for 10 years, for 40 or 50 years. Ever since, back in the 60s, people didn't fund these pensions at all. Ever since people got the idea of funding them, people not able to fund them. But there are some important changes. I mean, first of all, the loss in assets. Then there's the fact that, and the state and local revenue declines. But there's also the fact that some of the reforms since 2008 were basically to cut off new employees from gold-plated benefits. That undermines union solidarity. It used to be that, beginning teachers and retired teachers were all on the same page and they all supported the union, and that made them a powerful bloc. Now, if you're a teacher with less than 10 years experience, you're more, you don't want the old system. You don't want them to continue paying out full benefits until you run out of money and then you get nothing. You want your contributions going to a 401k or a similar thing, or you want to be put in Social Security. And I think that's going to be a major problem in a lot of these states. Well, I don't want to say problem. It changes the political calculus. We no longer have a united union.
Now, in terms of the federal government figures, in a way, the federal government figures, they've got so much red all over the place that in the scheme of things, the state and local governments maybe aren't the biggest issue in that. Perhaps you could help me wrap my mind around the figures that we're talking about. So in California in 2009, you had a $19 billion deficit. And to some extent, the state governments, by the requirement of running at balance, basically at balance, they haven't had these blowout figures. 19 billion, if California instead has 40 billion this year, that's sort of a drop in the bucket relative to the red numbers we're talking about federally. It feels like the government could plug some holes in state government budgets. Are you saying that the pension losses have been so severe that if the federal government were to get into plugging the state budget deficits as well as the pension losses, it would become overwhelming red?
Well, it was roughly $2 trillion before the crisis, the unfunded liability. And it's going to be $3 trillion now. It would be $3 trillion if we had all the numbers to me. So $3 trillion is a lot of money even for the feds. But that's funny money. That doesn't matter. Those are actuarial calculations. And by the way, optimistic actuarial calculations to assume optimistic investment rates and actuarial projections. Here's what really matters. When does the pension funding get so low that people revolt? And my ballpark theory is if total pension assets won't pay 5 years of fund liabilities, then it's no longer really a pension fund. It means every dollar you're pouring into the fund is just getting paid out. It's a pay-as-you-go system. And once people decide something is a pay-as-you-go system, then the whole political calculus changes. So this is basically what happened in Detroit, Puerto Rico, that the funding got so low that people lost confidence that it really was funding. Nobody wants to, new employees don't want to pay into the system because they know that money is going right out the door to somebody else. Government doesn't want to pay into the system for the same reason. And the people collecting those benefits become a smaller and smaller interest group. It also is kind of what happened with Social Security as well, several times. Each time we had a reform that pushed the problem farther. So my scenario is the worst pension funds, probably Illinois, maybe New Jersey, maybe Kentucky, they just can't pay. And they just have to announce benefit cuts. Now, 48 states have either constitutional or some other kind of extra legal protection for pension benefits. It's an incredibly difficult court fight. States can't declare bankruptcy, so there's no court that can obviously adjudicate these things. But some of these states is going to do a Detroit. They're going to default on their debt. They're going to cut pension benefits. An enormous fight. But once one state does it, lots of other states, it's going to get resolved somehow. Maybe the federal government will come in and help. Maybe, creditors will take most of the hit. Maybe pension beneficiaries will take most of the hit. It's not going to be taxpayers. Taxpayers are simply not going to come up with money for this. However it's resolved, a lot of other states are going to take a look at it and say, okay, we can walk away from some of our pension debt. We can get rid of this nagging problem we've had for a long time. And there'll be a one-time hit. We'll have some strikes, we'll have some process of turmoil, but it's better than staggering along, pretending the problem doesn't exist. So this is why I think this is kind of I think the most likely scenario for 2021, that we get one or two really big pension funds, say Illinois and New Jersey, going broke. We see that resolved somehow in a very messy, Detroit-like contentious negotiation. And then when the result of that is seen, a lot of other states say, hey, sign me up for that too. California, New York, Connecticut, places like that are going to want to do that. Once most states have done it, every state is going to want to. Who's going to want to pay your pension benefits if you don't have to?
The macroeconomic implications are limited. It's really a fairness issue and a political issue in the individual states. Is that fair to say?
I will say that and there really isn't that much room to, for all of the fighting and contention. There's really not that much room. You can't let anyone starve. Okay, so you're going to do what they did with Social Security. You're going to cap benefits. So if you're pulling down $120K a year state or local pension benefit, you're going to get to 60. The healthcare benefits, you're going to get a Medicare-like plan, possibly even Medicare. And you're going to tax the pension benefits. So, anybody earning over $60,000 a year who receives a state pension is going to have like a 50% surtax on that pension income. That's really the only political way to solve it. You can't, you're not going to cut, benefits below, so the people who are living on, $2,000 a month have to live on $1,000 a month. You just can't do that. And you can't pay everybody. So you're going to take it from the higher pensions and the higher income pensioners. Creditors are going to take a hit, but they're not going to take too big a hit because the state has to keep borrowing. So there'll be like a 10% haircut on municipal creditors. Exactly how that happens, I don't know. The bigger political question, if you're trying to predict outcomes, is will all of this get rolled into one problem? Will the federal government come in and basically subsidize the least prudent states at the expense of the more prudent ones, or will will Illinois and Connecticut and New Jersey retirees have to take a bigger hit than say Utah or Wyoming retirees?
At the same time as these state pension funds are going into trouble, you do also have a lot of local pension funds that could have Orange County-like situations.
That's absolutely true. And in fact, it may be the local that triggered this. The crisis is triggered by the worst people in the worst position. They have to be big enough, right? So in Orange County, Orange County is pretty big. Detroit's pretty big. They weren't big enough to really trigger a national issue. But if it's Chicago and New York City and the state of New Jersey and the state of Connecticut, you get those together and you just can't press these and some overall solution. What I tend to look at aggregate numbers. That is very misleading because when I talk about the Illinois 20% funded, some of the funds in Illinois are 50, 60% funded. Some are 5 and 10% funded. And it's a 5 and 10% that are going to trigger the problem.
With regard to the federal deficit situation, just as the pension fund was long known to be a problem, demographics are a driver of this. Demographics are also a driver of long-term federal budgets. It's long been known that we were sort of treading uphill from 2020 onward. Now you've got the virus, which is increasing red figures. Do you have concerns about the federal budget and federal government financing and inflation, or do you think we'll muddle through okay?
Well, let's say, we're going to wake up after this with a hangover. A lot of hangovers. And one we just talked about the pension funds. Another one is the federal budget. Now, the $2.2 trillion stimulus doesn't go all to debt, right? A lot of that is money that's supposed to come back in. A lot of that is not a cash outlay, but it seems we could easily add between the $1 trillion we were planning to add to debt anyway. Let's say we add $2 trillion to debt because of the virus. Will that be the trigger where lenders start getting reluctant? I don't think so. My gut is that this is something that will happen someday. Someday, I think lenders will wake up and say, we're no longer 100% confident that the U.S. can roll over its debt. And we see these things. Historically, these things happen suddenly. So interest rates are low, auctions go well, interest rates are low, auctions go well. One day somebody says, gee, maybe the next auction won't go so well, so therefore I won't bid in this auction. And then once that happens, people say, hey, this auction wasn't so great, I lose faith. And you get like a bank run, and very sudden. And so we wake up and we say, okay, the auction almost failed, and it only succeeded because the Fed came in and bought some stuff, and interest rates went up to 8%, and all kinds of things. Well, at 8% interest rates, Congress isn't willing to pay the interest on the debt. And so you get this thing. But I don't think this will be the push that makes it happen. And I also think that we could go on for both of our lifetimes without this ever happening.
So the primary dealers, if they have the capacity to take on bonds at auction, they have to do so. Is that?
Yes, yeah, and so, but that's kind of a trick. If you're not really finding willing lenders, right? If people are only lending because they're forced to, then the system quickly breaks down. Because the only reason people trust U.S. Treasury debt, nobody really expects the U.S. will ever repay its debt. Right? It can't tax enough to spend to cover current spending. What is the chance that we'll find the will to raise taxes to cover all current spending plus enough to repay the debt? I mean, it just isn't plausible, at least, the next 20, 30 years. So if nobody expects them to repay the debt, the only reason you lend is you think, well, somebody new will come in and lend them money too. The minute you think that's no longer a 99.9% probability, but only a 99% probability, then it's a 90% probability, and then it's a 60, and then it's a 10, and then it's a 0.
So you tend to get these sudden stops, and although the primary dealers are forced to buy at auction if they have the capacity, we would think that the Fed is fully supporting the primary dealers and will give them all that they want. That's not enough protection.
Well, no, I mean, then you're just monetizing the debt. Effectively,
right.
Once you've monetized your debt, you don't have voluntary lenders anymore. Or the interest rate gets high enough that Congress isn't willing to pay the interest on the debt. And, if you just look at the federal budget, with and assume a 5 or 6% interest rate on the debt, it just breaks down completely. And so at that point, I think Congress would have I would expect a negotiated restructuring. I think Congress would, negotiators would say, okay, we're going to extend all Treasury debt to 30 years at a 2% interest rate. And I don't think lenders would be that unhappy. I mean, they'd yell and scream, right? You got a 12% Treasury bond, you're going to be really unhappy to get 2%. If you have a 2-year note, you're going to be unhappy it went out to 30 years. But I think those notes would trade pretty close to par, assuming this was combined with some fiscal and monetary reforms. And you wouldn't lose that much afforded, and the uncertainty would be gone. So that's kind of that's what I think is a likely outcome.
Interesting. I haven't heard that contingency introduced.
I'm not predicting when it will happen. It could never happen. It could happen, 20, 30 years from now, or it could happen tomorrow.
Well, Aaron, I've taken 80 minutes of your time. I really, really appreciate it. And I think my audience, which, as we know, there are a lot of poker players in there. There are a lot of new financial market participants. I think they will get quite a lot from this.
I would just going back to your time at AQR. I think it was in 2007. We rented a movie theater, and local movie theater, to have you come in. You're one of the most popular presentations we ever had. Back in here, a couple hundred people show up and listen to your talk, and that was a lot of fun. I remember it was about poker and gambling and life and finance. So thanks for having me, and I hope people got some insight from this podcast. None of this was investment advice.
Of course, and I can assure you that there's going to be a lot of Twitter interest in your Bitcoin take. So they might my audience might force a second episode. We'll have to see. I might be begging you for some more crypto takes later on.
All right. Well, maybe by that time I'll have turned my attention to my crypto portfolio.
All right. Thanks so much, Aaron.